ours.
Yeah. Anyway, good morning, everyone. Thank you for joining us for another edition of our weekly real estate backstory. We kind of go over the comings and goings of things we see happening in the real estate world. We're sorry we missed you last week, but we are back. My name is Alan Richardson. I'm the managing broker at Maximum Realty and Realtor Partners.
My name is Meaning Richardson. I'm the compliance broker for Maximum One Realty and Realtor Partners.
And we want to kind of jump in. There's all kinds of cool things happening right now in the real estate world. And we kind of want to start off with, we keep hearing, and not just us. We're gonna kind of address this morning. The elephant in the room is that everyone's like, is the housing market crashing? Is this going to be 2008 all over again? What's happening here with the market? We're going to share 3 slides with you that we kind of want to highlight. Say share 3 more times. Sorry. I'm just in a very sharing mood today. All right. Allow me to share my screen. Anyway, so the first one here is the real estate house price index. And so this is the trend that we have of home pricing, how it's been since 1970. And so 1970, ever since 1970, you can kind of see the same trend line and property values tend to increase between 3 to 5% every year. And so the trend line has been true for the last 50 years. And guess what? The trend line is still true. Yes, we've seen in the past couple of years, we've seen a higher peak, but we also have valleys. And so, are we looking at a valley coming up? No, actually, if you actually look at the trend line, where we're at now actually follows the trend line. And we do believe that property values are going to be flattening out, but we're not looking at property values dropping. And so that's one of the very first things that we kind of want to share with you. The next thing here is, what about new construction? How many homes have we been building? Well, if you look at it, kind of what's gone on for since the 70s again here kind of thing. It's probably the 80s. But you can kind of see these are the average number of housing units that's been completed every single year. And so we all remember what happened in 2007, 2008. All of a sudden housing just dropped like a rock. And so when that happened, builders have not been building at the same level since. Matter of fact, we have 14 straight years below the 50-year average. And so we haven't reached the 50-year average.
We're almost there, not quite.
Well, I mean, but the thing is,
we're also making an inventory that was lacking for a long time.
Well, but we're almost at the median. We're not at the point where we move into the positive, right? This is just the point where we just start breaking even. And on one hand, you say, okay, that's great, but guess what? We're already in a deficit of 4 million households inside the United States. And so that's already not a great place for us to be. And so all we're doing is getting up to that level. And the builders are actually slowing down, which I'll share with you in a minute.
What's interesting, last year we were about 6 million inventory deficit, and now we're in
4.5. Yeah, 4.5 million.
That means the builders been catching up a little bit, but at the same time, we still have a deficit.
Yeah, well, and multifamily has been growing much faster than single family has.
We have seen a lot of apartment building that are investor owned, that are created strictly for investors.
Yep. Now, one other point that we really want to highlight for you guys is, what about the U.S. population? If you look at the U.S. population, the biggest population group we have are millennials. And so you can see kind of what's gone on. Used to be baby boomers was the biggest group. Well, the millennials and our Gen Z are the largest population group we have. Right now, that group accounts for 81% of our buyers. That's 81% of our buyers that are under the age of 32 years old. And 32 years old is like the magic year kind of thing, because the median first-time buyer age is 33. And so we have our largest population group that is younger than the median first-time buyer age. It's going to be moving in and looking for us. So now, what does that really mean for us moving forward? We're going to start seeing a lot more disparity between the different levels of pricing. So anything under 300 on the south side, that kind of stuff here, that's going to be a really hot commodity. We're already starting to see a little bit more inventory tick up in, especially in second home markets, things like
Mhm.
that. But pricing is going to be one of those that really does impact, or when I say pricing, the different pricing tiers is one that's really going to
Impact the
right,
demands.
because it's going to continue to be a seller's market. Anything under 300 is going to be a seller's market. Anything under 250 is going to be on fire. If it's under 200, I mean,
It's,
Katie bar the doors kind of thing.
well, it's probably as is on 200s right
Yeah.
now. So,
And that's just what we're seeing. And so I know that that's a shift for a lot of our buyers and sellers to make. But that's the thing, is that, for our sellers, it's got to be, listen, if your house is over $700,000, we're not going to have as much inventory on it. If your house is in a secondary home market on a lake and that kind of stuff, it just doesn't have as much demand right now as it had previously.
And the reason why previously the demand was good is because the interest rate was really low. So therefore, it made their monthly payment much easier to swallow than the current interest rate.
Well, I'm glad that you said that.
Yeah.
What good timing, because mortgage rates have dropped their biggest drop fall since 2008. Over a half a percentage point in the last 2 weeks, rates have dropped down. So we're seeing a slight increase in inventory, and it is a slight increase in inventory, and we're seeing interest rates starting to come back down. Anytime the Fed announces anything, there's always this knee-jerk reaction that goes on in the markets. And not that the market's directly affected, but mortgages are tied to the 10-year treasury, and out there in the investing world, when the markets go crazy, people jump into treasuries, which drive the treasury values up. So we've been expecting this to drop off, is kind of what I'm trying to say. And so seeing that, we see this being somewhere in the low fives moving forward throughout pretty much the rest of the summers, where we really should be.
Right. And by the fall, I project that the rate will come up just a little bit more. It just depends on what the market's doing and the inflation rate,
right,
and how the government's going to control that.
Well, and so, but for our buyers, for a long time, we've been saying, gosh, we wish we had more inventory. Gosh, we wish the rates would come back down, especially here recently. Well, now we've got rates coming back down, and we're seeing a slight uptick in inventory,
which is great. That's what we needed.
But one of the challenges we have is everyone's just a little bit consumer confidence is low. Down. It's actually at a really low level, and that's one thing that I'm not saying this because I want to get political or because I want to, like this is not a news show kind of thing, but we want to talk about how these things impact real estate. And so a lot of times when we're talking to clients and engaging with folks, understand that most of the folks that you're talking to are going to have a negative slant about what's happening with the economy, what's happening with the housing market. You can say, wow, things are really not that bad. Things are going pretty good here. You can lay these things out and understand that you're going up against preconceived notions of like how things really are, or not how things really are, how things are perceived in there.
Correct.
So, for example, this is a recent news article I wanted to put out here. And it says, housing inventory is spiking in some parts of the United States. And so then they list all these places in the US where some housing inventories are up. And I'm not saying that all markets are different. All right. Housing, no matter what, is always local. And just because there are a few markets, well, what does that really mean? Does that mean that our inventory levels are running nuts? No, especially not here in Atlanta. We're not seeing that. That same kind of thing goes on. If you look
at it, that's 1, 2 in California,
well,
2.
Well,
3,
the thing is
Florida.
that you can cherry pick markets anywhere, and even inside those markets, they're cherry picking smaller segments of that market, kind of thing. So let's look at what are some of the real numbers looking at, because I think it's important that we understand that if all we listen to are headlines and don't actually look at the data,
the details,
it will skew us, and that's what we don't want to have happen. So first thing here is this is national data, but the median sales price is running 12.5% year over year. And so is that as high as it has been? No. But does that mean that things are bad? Because what you'll see is that as soon as it starts dropping into 4, 5, 6%, they're going to be like, property values are dropping or crashing. No, it's just that from where it was to where it is now, we're still looking at being really,
Pretty
really
healthy
flat. Yeah. I
increase.
mean, we're still running a 12.5% increase year over year. That's still double-digit growth. Okay. Excuse me. How about our median asking price? What's happening there? We are seeing a real shift here. And so we're seeing where so overall, the median asking price is up almost 14%. And you know, right now, median asking's up about 14. Overall sales volume is about 12.5. So
what does that tell you?
Well, but if you look at our trends, what we're seeing is that folks are having to adjust their pricing. They're having to be very realistic about things. The days of our sellers just kind of saying, I'm going to throw a price out there, basically just like throw it and stick it on the wall. And then if you don't like it, tough. That's not here anymore.
So if the median asking price is up by 13%, almost 14%, while your sale price is only up 12%, so there's about almost 2% adjustment in there.
There is, but you can also see the trend, right? Median asking prices are coming down. Now we're seeing where the greatest decrease in asking prices is in over $400,000. Really, from about 350 up is where we're seeing the biggest decreases in asking price, or the biggest amount of price drops. Now, in correlation here, mortgage payments mortgage payments are up. There's no doubt that they are up. But if you really look at what's happening with mortgage payments, there's been this knee-jerk reaction. And what we've seen is that buyers have, they know the interest rates are higher, so they can't adjust their mortgage. So they have to adjust what they're buying. And so again, this kind of illustrates what we're talking about, as far as it's much more going to be about the price of the property and their payment than it's going to be. And that's why we're seeing such disparity between the different price points in our markets. Now, every market's very different. Entry level in Sandy Springs is completely different from entry level in Griffin, for example.
Absolutely.
So it's we're not talking. We can't just give a broad number here that kind of goes across the board. But we are seeing we are seeing mortgage payments going down, not because of interest rates, but because of the properties that they're buying. Now, what about pending sales, right? Because one thing you'll hear is that pending sales are down. Pending sales are down. And that's true, right? Pending sales are down. Pending sales are down 13.5%. How are we compared to, say, 2020? Guess what? We're about 8% higher than we were in 2020. And oh, by the way, 2020 was bonkers, right? It was just nuts, right? We remember that. And that was better than it was in 2018, 2019.
COVID and everything else.
Yeah, but this is remember when after COVID during the summer, everybody was like, holy smokes, what's going on? It was just going crazy. Well, pending sales are still higher than there. So yes, pending sales are down from last year, but last year was bonkers. And so the fact that we're seeing still really strong pending sales, if you just read the headlines, you'd read pending sales are down 13.5%. Yeah, but if you put this into context, we're still in really good shape. We should not be stressed about this. How about new listings? New listings of homes. Everybody's like, well, inventory's increasing. New listings is down 1%, 1.5. Now, that's basically flat.
That's compared to last year. I understand last year was probably the greatest migration or cash out for most your seller, because they felt like the market was at its height and that they want to take the equity out of the house and do something and rent for a couple of years and then purchase again.
But I want you to put this together with the original slide, which I showed you, in housing inventories are skyrocketing in these select markets. They were showing 40%, 50% increases in inventory. Well, how about overall? How are we looking? Well, inventory's flat is overall how we're looking.
Well, it's still higher. It is higher than 2020, but much less than 2021.
Yeah, exactly. So how about active listings for homes? Now, we are seeing a trend, right? Are we seeing the listings of homes?
2021.
We're almost to the level of 2021, and we're we're a long way to go from 2020, right? So are active listings increasing? Yes. And praise Jesus, right? Because we've all been saying for months, right? Or years now, man, we need more inventory. I wish we had more inventory. If we had more houses, I'd sell more houses, right? Well, we've
It is
been
going
needing
up.
this. This is a good thing. This is not a, oh,
And
the
the
sky is
reason
falling.
why the active listing has dropped so much in 2022, partially is because the buyers were having much higher interest rate, and therefore
Well,
it
and
kind of stopped the market
well,
just a
but
little bit on
if
the
you were
seller side.
selling, well, if you're selling, the problem was where, I can make you homeless real easy. But
Right.
our sellers have to have a place to go. So seeing inventory increasing is not a bad thing. We're sitting at somewhere between a third to roughly half, depending on the market, of inventory of our inventory levels where we were just 3 years ago. So just the total number of listings that we have is so much lower than anywhere we've been historically on that. So seeing inventory come up, please don't take this as a negative. This is something that we really, really needed here. 45% of pending sales are under contract in 2 weeks. So that's still amazingly strong, right? And so are we looking at a housing market crash? Well, not when half of our listings go under contract in 2 weeks. That's not a.
And the other are either over listing or property in such condition it is overpriced.
Yeah, but what we're seeing is well-priced properties, well-maintained, it's well-maintained, price versus condition. The price is right, conditions right, the house is going to sell. We still have a lot of demand for housing out there. And so don't let the headlines talk you out of that. Right. This is our pending home sales index from Realtor, from the National Association of Realtors, and you can see it's really pretty flat kind of thing. And so we're not looking at pending sales dropping off. It's not terrible, that kind of thing. We are looking at price reductions. And so 52% of homes are still selling above list price. Over half are selling, and don't take that headline wrong. 50% of homes are selling at or above list price. So right now, over half our homes are still going for full price or more. And so we're still seeing where good price properly, good condition, good price is still going to elicit a really good sale. Now, 7% of our listings are having price drops. And this is what we're seeing in the price disparity based on price point. We're not seeing price reductions under $300,000 normally, unless the conditions just jacked up. We do have a couple of sellers out there that just think they can, and we got to keep them real.
They can list a property without any repairs or any what we'll call safety issues.
Yeah. The other thing is that a lot of our sellers are having to kind of come that, we have so many sellers that we've been hearing from. It's like, I only want a full price, all cash offer. That's not real. That's not what's happening.
I'm seeing more and more FHA and VA.
Yeah.
And what's interesting, just on the loan side of things, I'm seeing cash offer with Ribbon, but guess what? With a DPA program.
That's a first.
So caution to you on Ribbon. Ribbon does not do any DPA program. So if you're trying to do Ribbon along with a DPA program, it's not going to fly.
Well, Ribbon will be actually talking at our sales meeting tomorrow. So we have our monthly sales meeting tomorrow, and Ribbon will be talking about that. And I'm sure that Meg will speak to them about that.
No, inquire, because it's a knowledge that we all need to know in order to practice correctly and protect and safeguard our clients.
Now, talking about those price drops, same thing. We had more price drops at any time since 2015. And so are we seeing where the folks who didn't have the properties, so many folks were just, gosh, I don't want to do any repairs. Well, what happens if you don't do repairs? You're gonna have to drop your price. Well, I don't want to do this. I don't want to do that. The reality is coming at them right now. And so they've got to be ready for that. At the same time, we have new construction that is really, really kind of dropping off here a little bit.
Well, honestly, a lot of new builders are not doing any listing until the sheetrocks are up, because it's taking they're not doing any pre-selling because it's taking them a long time to get permits from the municipality that they're having a hard time with right now.
Well, but we know one builder that pulled all their their pending land sales that were projecting any new construction over 300,000. And I think that's really a good thing, because right now new construction is only about 10% of new construction is priced under 300 or less. And that's where the builders have to get if they want to start moving into this marketplace right here. So I know that the builders are seeing a lot of price increases on their goods, both labor and materials, that kind of stuff. Just construction pricing is up about 19% for them. So I don't dispute that that's going on. But the bottom line is they've got to build houses that folks can buy. And
Correct.
so we're seeing where all of a sudden all those builders that were all
400, 500.
all hoity-toity and
No,
about
it's
you can
not
do
that.
this. Some
Honestly,
of them were. Let's
what
just
happened
call a
is
spade, right?
the interest rate does have a huge
It
impact
does.
on the new construction as well. So when the rates start creeping up, I mean, it is what it
I
is.
just love being able to look at the builders and be like, oh, remember when you were trying to
Don't be
dog us
mean.
out? Yeah, that kind of stuff. No. I remember. We all
No.
remember. Yeah.
Well, it's that they were
Yeah.
decreasing their commission and
Yeah.
putting value in
That's
our
dirty.
services. And so therefore, I'm seeing some incentives on
Yeah.
the
Now
new
they're offering
construction,
4s and some
new
5s.
construction
Yeah.
services and also incentive for the buyers.
I'm with you. So at the same time, we're also seeing, guess where the bidding wars are now? Rentals. It's especially hot here in Atlanta. It started off kind of in New York City, and now Chicago and Atlanta are probably the 3 places where we're actually having rental bidding wars going on. With the massive jump in interest rates over the first half of this year, a lot of folks said, we're just going to rent. We're just going to rent. And so now the renting market is going bonkers with it, kind of thing. That's kind of driven that. At the same time, when you look at in response to this, I guess you'd say, Redfin came out and said, well, is it cheaper to rent or cheaper to own? Redfin is a big aggregator of real estate data. And so they just pulled up and said the average monthly mortgage is $1,700. And the average monthly rent is $1,900.
So 200, that's almost 200, what, $31 more?
Yeah.
And honestly, that's money that you can't put in savings. That had just gone straight to expense.
Well, and I still think that, for a buyer, they need to be in a home for 4 or 5 years before it really does make any kind of sense. They're not going to pay any principal or anything down for the first number of years. So if they're not planning on being in that location for 4 or 5 years, I don't think it's a good choice. But that being said, wealth in the United States is tied up.
Arm rate is really good that you absolutely hate.
Yeah, I don't like
know.
I
You
don't like
absolutely hate it,
I don't
but
like
but
The
that's
distal rate
also
mortgages are a
taking
bad
a
thing.
gamble on the market is going to
Yeah.
be as healthy as it is today, and also that you'll have a upside versus downside.
Yeah. Well, now this is we got some data out from Mike DePreet, and he pulls a lot of data on investors and that kind of stuff. And he shared some information both about Zillow and Open Door. And something I wanted kind of to share with you guys was that, first of all, on Open Door and on Zillow, they only get their average response rate as a company is around 1.7 to 1.8% of the folks that visit their sites convert. And so I want to start off by talking about that a little bit, because so often we don't understand that when working lead generation and working with trying to attract clients, it's still a numbers game. We still have to understand that these are big national companies, and all they do is lead gen and conversion. And their conversion rate is a 1.7, only 1% of folks. So Open Door generates over 2 million inquiries a year. Only 1.8% of people actually will go through that. So you can see that a lot of times there's clients that are interested in what Open Door has to say. And so we as realtors really definitely need to make sure that we're talking about who the iBuyers are and what the costs associated with that are. But we really also need to be looking at what is our lead generation? What are our conversion rates? How do we convert? And what are we doing to generate these same kind of leads?
Listen, there's no quick fix in real estate. Real estate is about relationship and time investment. So excuse me, if you're okay with giving away a large portion of your commission, then buy these, please. But if not, I promise you, if you do a great job with your client, you'll never have to look for leads.
Work by referral. Yes, we agree entirely. Now, overall, investors are still a huge player. Atlanta is the #1 market in the United States for Atlanta. Yeah, they love us. And so we've actually seen this drop off on second quarter. This is data through the first quarter of this year kind of thing. You can see it's a big jump, almost a 10 percentage points from the year before. And so part of that is, and we've seen the investors really pulling back with what's happening in the market right now. We know that it's not that high in our market right now as well, but still investors are making a big piece of our market.
Absolutely.
One thing that is going to be very impactful for them is look at what's happening with the flipping trends though. So you can see that overall their gross profits are up nicely, but what about their returns on investment? Everything's costing them more. They're making some of the lowest returns that they've almost ever made.
Gross profit equates to the total profit, and the gross return on investment, meaning that is the actual return for your investment. So they may have expenses from the gross profit that supersedes what their returns are.
Yep. At the same time, what are the average days for a flipper to flip a home? Right now, the average is around 162 days. You can see that as an overall, 180 days is kind of our average long term of how long it takes. It normally takes about 5-6 months to flip a home is the average time frame. A lot of times when you have folks, when you have clients and that kind of like, how long does it take to flip a home? The median is right now 162 days. And so, because a lot of times folks watch these shows and they think, well, gosh, you can do this in an hour, right?
That is presume the conditions, right? That you have all the labor and all the materials and there's no hold up, and Mother Nature's is cooperating as well. So.
All right. And then don't forget, tomorrow we have a sales meeting in all of our offices.
I'd like to invite all of y'all to come to our office and just check it out, because Alan actually gives a really great data on what's going on in the market. If you're not our agent, please come in. We will love to meet you.
And then on Thursday, I'm also teaching making money with real estate investing. I'm going to be in our Conyers office teaching that one. And I believe that one's sold out as well. So I don't know if it, I'll double check, but it's my newest class kind of thing.
And
so
everybody
it
really
does
loves
get that.
it.
So if we can be of any kind of service, please call, text, smoke signals. I hope you guys have a great week.
Thank you and have a great Monday. We'll see you next week.